Guys, welcome back. Nate Fisher here from the Financial Enthusiast. I had just done this whole thing over the course of 45 minutes, and it's been so long since I've done any of this stuff. I forgot to have my microphone capture anything, so let's try this again. I'll try and breeze through this in probably about 20 or 30 minutes. We'll see what happens. But this video here is for pretty much the absolute noob doing options. You guys that have been doing this stuff for years, professional guys, you're probably not going to get much from this except to make fun of me. So have fun with that. So disclaimer here, I'm not a financial advisor, nor am I a licensed trader. Options are risky and you can lose everything. At the end here, I'm going to talk to you about some big risks that I've had and some lessons I've learned. This is for educational purposes only. Seek professional financial advice and don't listen to an idiot like me on YouTube. There's plenty of guys out there on YouTube that do have the licensing and do have the track record of doing this. This is for the new person so you can understand why you would do options, when you would do them, how much to use for them, and how to get out of them. So what exactly are options? An option is a contract to buy or sell a number of shares at a later time, usually in batches of 100. So one contract would be 100 shares. At least that's the ones that I've seen so far. A call option means to go long. It means you're betting that the price goes up. Put option is kind of the same of going short. Means that you're betting the price goes down. With options, you're buying the right to buy or sell at a specified price at a later specified time. You pay a time premium for that right. So you're not actually buying the shares. You're buying the right to buy or sell those shares. So why would you buy options? I'm going to go through some examples here about how it's different than if you just bought the regular shares. With leverage here, you can control thousands of shares for a fraction of the price of purchasing them. The high volatility can make you pretty rich pretty quickly, and I'm using this as a relative term with rich, by the way. With the bull market that we're in with gold and silver, think of these moves up as a sawtooth pattern where maybe something moves up 5, comes down 3, moves up 4, goes down 3, moves up 8, comes down 2. You get the idea. There's a sawtooth pattern here. At times we may have a prolonged pullback, and you can play that volatility with puts if you want. But last summer when things were pretty high up with prices, there was a lot of the experts out there that I didn't listen to. They kept talking about things are going to pull back, things are going to come down, and everyone's buying in because the price is real high. And there's a couple guys that did call that, and they've been in cash, and they're probably just sitting here, raring to go and buying a lot of these things. So the high volatility is what I'm going to be playing here with a small percentage of my trading account. Elements of an option, and I'm going to use call options here. I'm not very good with puts, so I'm just going to specifically say, hey, if I think a stock is going to go up, I want to do a call option. So what am I talking about here? An example. So yesterday, I bought 20 contracts of GDX, which is the Gold Miners Index. These are the seniors, for September 17th, 2021, at a strike price of $36 for $2 each. What this means: 20 contracts is 100 shares times 20 contracts is 2,000 shares. I have an option to buy them on September 17th, 2021, and I can buy them at $36 each. But I paid $2 already. So essentially my break-even price would be if the share price is going to be over $38 in September, that would be a good buy for now. I control the right to buy them, and this is a bid-ask situation and is only worth what someone is willing to pay for them. There can be low volume at times. If I were to buy one contract on September 17th, it would cost me $36 times 100 shares, or $3,600. To buy all 20 would cost me $72,000 in September. Now I don't have $72,000 laying around in my account. Not yet, of course. Not free. But if gold and silver go to the moon, and let's just say for argument's sake share price is $150, that it's not going to be. But if it is $150 at that point in time, maybe I sell a portion of my call options and then exercise the rest of them. So if I were to buy 36 shares outright yesterday, it would cost me $36,000. Now, I think that's a typo there. I think I was referring to the contracts and the like. I'll move on from this. It's not very important. I'll go into the comparison here, which actually talks about it. So I bought 20 options, and that cost me $4,000 yesterday. Now, in some of these slides, I talk about some of my other options, so I don't want to confuse you too much. I did buy 20 options as well on Wednesday for approximately the same price, but I'm talking about yesterday's here, for example. So if I use that $4,000 to actually buy GDX shares, I would have only been able to get 111 shares. So if GDX price moves from $36 to $40, let's just say in the next week, this reversal pattern happens, GDX goes back up to 40 bucks. This potentially has a gain of $4 per share. So with the options, it would be equivocal to about $4. So let's just say those those options, then the profits on them could be $8,000. The shares, the profit would be $411. So in this particular scenario, with a sharp move up, I'm able to get 20x the return using options than if I were to just buy the shares outright. So why don't we all use call options all the time for everything? So anyway, I'll go through a couple scenarios here. So the strike price is $36 on what I bought. If the price is $38 on September 17th, these are in the money because it's greater than $36. If greater than $36, your account may automatically purchase these shares. So again, there's that $72,000 I was talking about. Now, if I bought these each for $2, so if I wanted to break even, again, my break even price was $38 share price. So I don't necessarily want to exercise them at $38 because it's kind of like if I just bought them for $36 and then $2 later, it's a wash. So the concept here is I'm trying to capitalize on large moves on GDX. Reason for it being is because as time gets closer to September 17th, the time premium that I just bought decays. So usually around 6 weeks out, it starts accelerating downward. So those options to buy may actually decrease in time premium, but if the share price increases significantly, that can bring up the options price. So you can have the share price going up and the time premium going down, which makes your options kind of go sideways. So you're looking here for shorter term options. You're looking in a situation where you think there's going to be a strong move up in a short term. So why don't we all do options? One caveat here is all $4,000 I put in could go to zero. So, for instance, if the share price is $35.50, your brokerage is not going to exercise those options. They go to zero, and that $4,000 that you gave over to the bank to buy all those shares, those 2,000 shares, those shares get returned, and that money goes to zero. So they pocket that money. So it's possible that GDX could go to 34, 33, 25, 20 if there's a black swan event. So I could lose that $4,000. So part of that is how you manage that. I'll get into that in a little bit later. But if I bought them for $2, maybe I have a stop loss, or mentally I'm sitting here thinking to myself, hey, if the price of these things gets below $1.35, I'm just going to sell them for $1.35, $1.20. I want to get what I can for them and get out. Typically on these types of options moves, you'll see some of the stop losses set kind of tight because you're trying to play an up move, but if you get caught in a down move, you want to sell them quickly and get out. Typically when I play these things, I know I might have a little bit of down move in it yet, so I might buy them and wait for, you know, a 25-30% pullback and just continue. Maybe I'll add more at that point because I'm expecting a sharp move up. So I can actually dollar cost average my options pretty good on pullbacks. Most of the options I'm buying are 6 to 12 months out. In this particular scenario, I feel there's going to be a sharp move up, which I'll get into the overall play soon. But I'm expecting a sharp move up, which is why I only did a 3-month option. Other people think, hey, I'm going to do a 1 or 2 week option or 1 month option. That's too risky for me. If there's a black swan event tomorrow and the stock market drops 500 to 1,000 points, you lose everything in that short time frame. And maybe if you do that with 1% of your trading account for 100% return, possibly you do that. But I just don't do. My personal experience, I don't do the very short term ones. So why don't we all do options? There's a lot of volatility there. So what we just saw in the last 2 days of a pullback scares the bejesus out of people. So yeah. So why would I do options here? There's a setup I'm going to get into in a minute, but those options that I just bought, there is a further risk of a downside move. Perhaps you set your stops to minimize a loss. The sharp moves up get sold down to collect profits. The sharp moves down get bought when people smell deals. So that sharp move down I saw, I'm betting that there's a sharp move back up. And remember, I used the term betting here, which a lot of this stuff, no one has a crystal ball. So options, not sure thing. Options, betting, probability. Remember that. Expectation here is a fast recovery. At gold's recent high at end of May, the GDX was 39.60. GDX dropped to 34.80 yesterday. So I saw that sharp move down. There was actually a gap in the move down with the GDX. And a lot of times those chart guys will tell you gaps always get filled. So if this gap does get filled in the next week back up, I'm thinking that the GDX is going to be somewhere around 37.20. So that could get me a 2x within 1 to 2 weeks using the options that I bought yesterday. Now, at the price they are probably now, I haven't looked recently. It's 10:30 on Friday. For all I know, they could have smashed gold another $100 while I've been recording. But early this morning, before they smashed it at 8 a.m., I was looking at I was probably looking at a 2x already. So why do them here was it was a quick 2x for my money. I bought a bunch of options other than the GDX yesterday, and I bought a bunch on Wednesday, which I'll get into. But here's the situational setup. Over the last 2 months, I've seen gold and silver daily moves have very strong moves over 2 months. It was a very high RSI. And with that, I felt it was bound to have a correction. I was looking at the fib retracement levels as to where I'd be potentially buying. At those high RSI levels, and this is very important, the big overall theme here is going to be RSI. I'm buying at low RSIs, I'm selling at high RSIs. Or as RSIs move up, maybe I'm buying a little bit as RSIs are going down. So I got into a lot of this when the RSIs were over 70. I got into a lot of cash, that is, I'm sorry. And I'm on Twitter and I follow 150 guys, and you can start to see patterns when these people are talking about, hey, retracement's coming, hey, pullback coming, hey, and you start to see this amongst 30 different guys. You're like, hey, these are the professional guys. I'm an amateur. Why not get into some cash? So at that point in time, maybe on some of my juniors that I have a lot of profits in, I was taking 10 or 25% off the table. Maybe some of the dogs that have not moved, I'm selling them off. And so basically I got into like 15% cash over the last couple of weeks. So maybe closer to 20%. So when you're sitting at a 70 RSI, I'm expecting a pullback to happen, okay? So how does that RSI correct itself? There's a couple different ways. So it can be time or price. So how does the price correct? If you look at the top left, you're looking at the gold move from last summer. Now from that high RSI in the big circle there, that was the top. That was close to the end of July. But funny story is that happened pretty much, the start of that was pretty much today, a year ago. So how did that move? How did that RSI get worked off? 6 weeks it moved up. RSI went way over 70. It was closer to 80. And then you saw the price correct. And when the price dropped so much, the RSI went down. And then you saw that a couple weeks later, RSI was still pretty high, and that triangle had formed and it resolved down. And when that resolved down, the RSI went down to pretty much an oversold. And at that bottom area is when probably a lot of the technical guys are looking to get in. That top part there, when there's a high RSI, that's when you hear the Jeff Clarks of the world saying that they're getting into cash. Idiots like me, back in the day a year ago when I didn't know any better, that's when idiots like me are FOMOing in and buying options then. Don't do that. Don't do that. The second part of here, how they can work off RSI, is time. Now, I'm looking at a silver chart from a couple years ago. On the bottom right-hand side there, you're looking at a high RSI over 70, and then you're looking at it about 2.5 months later, and the RSI is much lower. But if you take a look, that price had corrected over a longer period of time. It wasn't a sharp, drastic move. So you're looking at that potential low RSI. At that point is a possible entry point. Now, you didn't have a sharp move going into that. So maybe at that point in time, I'm looking at a 6 or 12 month option if I wanted to play an option there, if so. Figuring that, hey, there's with the low RSI, it's going to work itself back up and people are going to buy in. So maybe at that point, I'm doing a 6 or 12 month option, maybe even 18 or get your leaps further out. So that's the setup here with the RSI. I was looking at a high RSI with this the last 2 weeks ago or so. I saw the higher SI, started getting into cash. I'm sitting on a lot of cash. And then last week I'm seeing a lot of sideways movement. It was very tempting to kind of get in, like, because you're thinking, okay, it's not going to break down. It's going to continue to go up. I'm sticking with my guns. And then you saw the FOMC meeting, and they basically said, well, 2 years from now, we might go up a 1/4 point. We might go up a 1/2 point. We might have to tighten 2 years from now. And you saw all the algos and all the bots. You're looking at 90%, 85% or so of all trading is done with automation, quant analysis, all these tools, all these bells and whistles. And essentially when these headlines hit, it kind of was an excuse for a big sell-off. There was really kind of no fundamental news here that really changed anything in the near future. They're still doing $120 billion a month of all their buying of things. I think 40 billion of it or so is mortgage-backed securities. Oh yeah, you know what? Great recovery. Yeah. So if it was such a great recovery, we wouldn't actually need any of that stimulus, but apparently we do. So with that, they get to do something called jawboning, which is not actual change to policy, but they hint at a change of policy years down the road. And you see the headlines come out say, gold moves down on inflation. And you're like, yeah, it makes no sense. So anyway, at this first X here, when the move happened on Wednesday, I saw a 0.5 retracement. I said, oh my God, it hit my 1800 target. I first had an 1826 target, and I didn't buy there because it was just a strong move down. I wasn't looking. I wanted to try and see if there was a bottom, and it looked like it bounced off of the 0.5, and it did. It was a little bit of a fish line. It kind of went up a little bit, so I bought some of my options there. And then yesterday, Thursday, there was just a punishing move down on no news at all. And they talk about, oh my God, the dollar strengthened. Dollar went up to 91.5. Yeah, well, take a look a year earlier. When gold hit its all-time high, the DXY was at 92. So I don't want to hear it. What a lot of this is it seems to be excuses for big banks to paper the hell out of things. And they know where all the stops are set. So you had all these weak cans buying on the way up. All these people buying on the way up. All these silver options, all these gold futures. And then the banks just rinse them out whenever they get the news to do so. And they use that cover and they use the DXY as legitimate reasons to sell off. But what they do is they know where the stops are. So they do a tactic called running the stops. They get everyone out. And then the bottom, they're the buyers. They buy everything. They just sold off at, 1860. And they turn around and buy at 1770. And these guys don't have a losing record because they know where your stops are at. So I'm watching the fib levels. And then yesterday, I bought a ton in. And one thing I want to mention here is don't do what I did. Okay? At that top there, you can see that big circle. I saw the high RSI, and then the one hash mark was the RSI down at 50. I should have felt that it was going to go down further, and I said, you know what, let me buy in some here now, and if it goes down further, I'm going to buy more in, which is exactly what I did. I did not go all in on Wednesday. I used a third to a half of my cash. I forget exactly what it was. I'm buying some options on Wednesday. And then yesterday, I pretty much got fully deployed in. I have some wiggle room to sell some stuff if I need to, but I'm pretty much fully deployed in at this point. So my expectation is a V move. So I'm looking at the fib retracements here, and it hit the 0.618. Now, my caveat here is don't do what I do, because all the technical guys that you're going to listen to, they're going to tell you to wait for confirmation of a move back up. And they're probably right. However, again, I'm okay with risking the downside move here. I would continue to buy more and catch the falling knife because I just did not feel the fundamentals changed. And I felt that this such a sharp move down over the last couple of days of what, 150 bucks, 140 bucks. That sharp move down, I felt was going to be met with a very sharp move back up. So that's why I kind of went all in on these things down here. And that's why I would do options here. So part of this setup here is I also had a backdrop of gold last July. As I made mention, that circle on the bottom left there is essentially June 18th or June 18th of 2020. So you are here now. And then July of last year, I forget what happened. I think it was a hint of yield curve control. The hint or sniffing of it is what accelerated the gold and silver up. And that took it over its 1923 or so, and gold continued to rise up. Now, look at that RSI. That was telling all of those professional guys, man, this is way overbought. Hey, maybe we should get out now. And they sold off a lot of stuff. And then look at how that happened. So I'm sitting here thinking to myself, okay, last year, that was, at this point last year, it was a $377 move in gold in 6 weeks. The GDX, I went back on my charts and looked, and GDX went about $15 per share on that move. Now, maybe in the next 6 weeks, it doesn't go up 15. Maybe July is good this year and it only goes up half as much, maybe a third as much. That's still a $5 move up per share. So if you look at gold now, here's the setup. It was at the 0.618 fib level. It was a very sharp move down in 2 days. It was violent. I felt that we moved back up. Also, within like 2 weeks, you have this Basel III is supposed to be taking effect. Now, some people is debatable as to whether or not this is really going to affect anything, but it screams to me of a paper game of desperation to try and wash out everyone they can to buy as much as they can back cheaper. There was a lot of fuel spent trying to wash everyone out yesterday. So the Commitment of Traders report for this week will actually be published on, well, it'll be compiled on Tuesday and published next Friday. So that's when you're going to be able to see what really happened under the hood. I'm not very good at comprehending those COT reports, so I'll let the guys more expert than me handle that. Anyway, I now have 40 options on the GDX with yesterday's purchase. The potential revenue here with those 40 options is $58,000 on a total of $8,000 put in. That was the $4,000 from yesterday, the $4,000 from Wednesday. So I have a downside risk of 50% loss. So I could lose 4,000 of that if I needed to bail, and you know, if there's a black swan event, maybe I catch a bid at 50% of them. Maybe I get out with losing 4,000. So I have a 50% loss, downside loss that I'm betting on against a potential upside of 7.25x. So that's the backdrop of why I would do this at this time. So had I bought shares, it would have cost me $144,000 to buy those same amount of shares, the 4,000 or so shares, outright. And if I bought those 4,000 shares, it would have given me 58,000 or so profit, and that would have got me a 40% return. Now, that's a lot of capital to get 40% back in 6 weeks. My options, using just $8,000, can get me that same profit. So that's where I'm talking about the 7.25x. However, you have that March 2020 Black Swan event that can happen. So everything can sell off. That rug can get pulled out further from me. and the options could go to zero. Like I could wake up to $5,000, 5,000 less on the Dow tomorrow, and my hope to get 50% on these things might only be 25%. So that 8,000 can go down to 2,000. I mean, I wouldn't let it go for less than that, but there's enough time on these as well so that it's possible that the Dow makes a sharp move down and gold and silver build themselves back up pretty quickly, and I can get back to even. So a lot of this is risk, how much you want to hold, and this is part of that time option, the time thing on the call options, the 6-month, the 12-month options. If there's a black swan event, you could probably recover for them and still make money. But on a 1-month option, you could lose all of your money. So all this is about recognizing the opportunity and managing the risk. I set up the opportunity here, and now I need to manage the risk. In the bull market, you may have many opportunities like this to use a small portion of your portfolio to play the volatility. So some of the ways to play this, I looked at the sharp moves down. What I'm looking for in a very short term is to look for 2x or 3x on the way back up. I can wake up tomorrow like I did today, and I could wake up and GDX is up $3 a share or $2 a share or something like that. So if I buy the GDX options for $2, when they get to $4 or $6, I can sell 20 of my options or 13 of them or so. And what that means is the $4,000 I put into this, I could get back in 1 to 2 weeks. So my seed money I put in, I can get that back. And that's because, not because I just bought options and stunks go up, but because of when I bought them and where I bought them in the charts. So, you know, if I sell half of my 20 options, well, actually, sorry, I have 40 options now. So if I would sell half of them, I would be selling 20 of my options and I would be getting 20 of them for free. So this here was just mentioning my options I bought from yesterday. So if there is that price gap up and a sharp move, which I think is going to be a sharp move back up, because again, the fundamentals didn't change. This was jawboning. And when the algos digest all of this stuff and the people digest this stuff, they're going to realize how cheap this is, and then they're going to pile in, and that momentum is going to get a lot more people buying in. So if I can sell a third of my options at 3x, or even a quarter of them at 4x, which I did with WPG a couple weeks ago, actually last week. In any case, playing a sharp move down with that hits a fib level, and you can get a lot of free options on the house. So one way to play this is the sharp move down. When, let's just say the price has been going kind of sideways for the last month or two, and you feel there might be a 10% spike up or something like that. So what I might tend to do on something like that is buy some options that are 6 or 12 months out, and maybe, you know, sell them for 20 to 50% profit inside a couple weeks. So maybe you have $2,000 and you have a $1,000 profit, sell off, there's your family's grocery money for a month. Or you take half of that, you buy groceries, and the other half you put into, you know, an Explorer, or you top off somebody, you know, one of your producing miners. If you're expecting sharp moves up, buy options with less time that are cheaper. Those are for the 3 months out. That's what I did on this particular situation. Now, silver is tricky because I think it's going to make a move up by the end of the summer, but no one really knows. And we know how the Fed is playing with the jawboning right now. So as much as the technicals and as much as I felt in February that the silver smash and the silver squeeze and all this stuff was going to happen, the Fed has been doing the best that they can to devalue gold and silver, just using their words. They're not using any policies yet. So if they're successful in continuing to do this, I think at some point in time, within 6 months, we're going to be seeing that $40 or $50 silver. So with the SILJ options I bought, I'm expecting a sharp move up, but I don't know when it's going to happen. So what I was looking for there was a lot of these technical guys, a lot of these guys on YouTube, far smarter than me, better degrees than me, experienced in trading professionally. A lot of these guys are calling for $40 to $50 silver by the end of the year. So my SILJ options are for $17 strike price by January 21st, 2022. And in that case, I'm looking for 6-month options. I had bought a lot of these six or 8 months ago. So they were a year out at that point in time. I continue to add to that. And I use a lot of the profits from some of these options to buy shares potentially. With WPG, I had a situation where essentially I woke up to a 4x one day on my options. I sold a quarter of them at 4x to essentially pay for my entire options. So I got a lot of them for free. And then I turned around and I bought some shares to de-risk in case in case that spike up went back down, which it eventually did. But when I bought the shares cheap, it didn't really hurt me too bad. So with the end game here, ideally in a bull run, you want to make as much money as you can. Now, if I just bought Newmont a year ago and held it with 100% of my account, if I looked at it today, Newmont today is pretty much the exact same price it was a year ago. So you didn't make any money. No unrealized gains, no realized gains. So in 9 years from now, Newmont can be 5x from what it is now. But what you want to do is capitalize on these moves where you can. At least that's what my goal is. You can do the, if you're in your 60s and you just want to do a long hold, you're probably not even in miners anyway, but because they're risky overall. But most of my portfolio is in the bigger producers with the GDX, GDXJ, SILJ, that type of stuff. I don't typically do individual miners. I had Newmont for a while with options, but like you can tell, Kinross recently had problems with a mine catching fire. Last year, Barrick had problems with possible nationalization of a mine. If you play the indexes, you're not going to get that same upside. But when institutions and pensions start buying into the miners, when they start seeing gold at 2,000, 2,100, 2,200, and they start running the numbers. Now, a lot of these big institutions have been contacting the miners individually for investment. When that big money starts coming in, it can't go into the juniors. It's got to go into the majors, but it's probably going into the indexes. So that is where the big money is going to move first. So a large part of my portfolio is playing the GDX, GDXJ, the SILJ, because when big money piles in, it's going there. And that's where I'm going to be getting a 2x or 3x on those shares, but I'm playing options on those shares. So that's further, you know, I might be getting a 5 or 10x in a year on a $200, $300 move in gold and a $20 move on silver. So a good portion as well. I do have some individual juniors and explorers that they can get 5 or 10x over the time if prices don't really move. If you're looking at $3,000 gold and $100 silver, like just one of my juniors, like Chesapeake, I did the numbers on it, and I bought them for like $3.50 a share, and I did some numbers, some stupid, crazy numbers. If this mine actually gets built, I mean, they're looking at they have 19 million ounces of gold and something like 530 million ounces of silver. If that were to ever get built in 2025, 2026. You're looking at $100 to $200 a share price for this. So, you know, you buy, you know, a tranche position of a miner like that and you tuck it away. They're not going to move a lot in the short term. But what you want to do is have things come due at certain points of time. So I have options that are paying off every month. And then I have certain miners that might move up and then I can take some profits off of there. And then I have some explorers that when they get a 2x, I'm selling a half of them, or 3x, I'm selling a third of them. So when I'm getting winners from these short-term options plays, maybe for argument's sake, I get a 2x in the short term, and that $4,000 I put in, or let's just say the $8,000 I put in, I get a 2x, I get that $8,000 back. Okay, now $8,000 is just running with those options, and maybe that doubles again down the road. But that $8,000 I just took off the table. Maybe $1,000 that is going back to the house to buy some groceries. Maybe $1,000 that is going into helping improve my rental properties. Maybe $2,000 that is going into my next options play on the next pullback, because I don't do puts. So there's a lot of different ways you can play this, but one of the things I wanted to make mention is when you're playing high risk, when you play high risk plays like this, whether you want to consider them low risk, medium risk, whatever, anything to do with mining and options is going to have a lot of risk. If you have a 2x on the table, try and take half of it off. like I've woken up a couple times to a 3x in the morning and I was like, yeah, I'm taking a third off. I sell a third. The rest of that I get for free. And then maybe the stock comes back down to earth and I sell it off and get rid of it then, and maybe put it on my watch list and buy it again cheap sometime later. But there's also ways of, maybe convert some of your winnings into, exercising options. So that WPG I mentioned where I had 4x and I sold a fourth of it off. Now those options, I had the option to buy them at $1.50 a share. Now, if WP would have gotten some good news and avoided bankruptcy, if that was the case, that share price could have been $20, $25 by September. So what I would have done was I would have just exercised the existing options I had, pay $4,500, and they would have been worth like $50,000 to $75,000. So because I managed risk and I took winnings off the table, I ended up getting out of WPG on bad news with a 36%, 37% profit. So, and that was a 3-week, 4-week trade. And some of my buddies lost a whole bunch on that because they wrote it up and they wrote it back down. So what I do in a lot of these things is I'm selling a portion into price rises. And I typically don't get into anything if I don't think the price is going to go up. So you have to find where good places to buy are. And you know what? I'm just going to recommend the Silver Chartist here for a minute. One of the things about their newsletter that they do differently than other newsletters they have is they actually have trade ideas each week. One of the things they talk about are they find certain shares, and I'm not even going to give their method away because I want you to buy into them. But they will go into the charts and they will show you certain stocks and why it's a good buy at that point. And I'm not going to give their secret sauce away. I think you should look at the Silver Chartist. Very inexpensive newsletter. A lot of work that goes into it. But they can give you some trade ideas. But also, lastly with the end game here, I'm also going to talk about, get into some cash. As those RSIs start increasing, I'm selling a little bit here as it goes along the way. 10% here, 3% here, 5% here. Maybe sell off some options here. And then when the RSIs are really high, that's when I'm just sitting there on cash and I'm just waiting for things to start moving down. So I didn't have a slide on this, but I wanted to add here some of the mistakes I made. I went through a couple of these in the video that I didn't have sounds recorded on, but one of my earliest things I did was I didn't know how to buy open and sell close. So when you buy options, you're buying open, and when you sell them, it's sell to close. That's something I think if anybody wants to do options, you need to look at these things, research some videos, go through what some pros do. So also one thing I did do right was I started small with like 1 or 2 option contracts. I wanted to see what happens if it exercises, what happens to my account. So start with one contract that might be expiring Friday, buy it in the money and see what happens. It's 100 shares, maybe $1.50 a share, costs you $150, see what happens. So that's one option of doing it. One of the big mistakes I did early on was selling market. When you sell options, it's just the same way you're buying. Don't buy market. You're going to see the bid and the ask. Generally speaking, when I'm buying stuff, I'll try and put a number in closer to the bid, and I'll walk it up a little bit. And if I'm selling, I'll have it closer to the ask price, and I'll walk that down a little bit. So that helps you when you're buying and selling what price to buy it at, because sometimes when you're buying dozens of contracts, a nickel or a dime on what you buy it for and a nickel and dime on what you sell it for can actually cost you thousands of dollars. So keep that in mind. Another thing I did that was a big mistake. Okay, so First Majestic. I love First Majestic. Love them to death. And in January, I actually had 80 call options, which controlled ridiculous amount of shares. Was it 80,000 shares? Some number like that. Forgive my math here. But I was controlling some ridiculous number, like 80 options I had for a strike price of $10 in January 21st of 2022. for $3.09 each were my average. So I accumulated this position, and it was worth a ridiculous amount in my account, but it was taking up a tremendous portion of my portfolio. And I was really worried that I was too much in one stock. Even though I got them at great prices, I was worried about, well, what happens if First Majestic has problems with the Mexican taxes that are not getting resolved and the share price drops in half? All my options could have gone to zero. So I was really nervous about that. So I sold a bunch of my options over the course of a week or two. I put that in other things, SILJ, GDXJ, wheat and precious metals. I tried to diversify out. But then what happened was silver squeeze happened. So I still owned, at that point, like 30 or 36 shares, 30 or 36 options, something like that. And First Majestic went from like $13 or $14 a share to like $25 a share. And I'm looking at my trading account, and my options are sitting at 5x from what I paid for it. I bought them for like $309, and they're sitting there at $15 each. And I owe like 36 of these things. And I'm like, dude, silver squeeze, we're going to $50. Yay. Yeah, well, that didn't last too long, did it now? So it went up over 30, came back down. And at the time, First Majestic was also going through a short squeeze, which pushed their price up artificially high. So I'm looking at a 5x. And what I probably should have done, just they're options. They can go to zero. 5x. Get out. No questions asked. Bank it. I should have done that. I didn't. And I wrote it back down to a 2x. So anyway, that was a big issue. When you have a 3x, 4x, 5x with your options, get the hell out of them. Because at any given time, the black swan events can happen. Like I said, you can also do, if you got a 5x, sell 1/5 of them. So even if the rest of them go to zero, you still, all of the seed money you put in, you don't lose. So that's another way of doing it. What else have I done with options? Yeah, the buying and selling needs to be at limit. And I say that because I brought that up because early on a year ago when I was doing some of these things, I bought into Kohl's. My buddy's like, Kohl's is worth so much more. You crash down, it's worth a ton. And I'm sitting there on something like 5,000 in profit on my Kohl's options. I'm like, oh, I'm celebrating. I go to sell and hit the sell button, and I went market. Now this is the first time I think I'd sold anything sizable. Like the one I did contract buy and sell was an oil thing, and I just did market, and it was like about what I paid. It was about what I paid for it, got out of it, whatever. But when I went with the Kohl's, it was sitting on 5,000 profit, and because I hit market, somebody was sitting there with a low bid, and my 5,000 profit turned into like $800 profit, something like that. I lost like $4,000 of profit by not doing a limit order, a limit sell. So that's something else you need to, I mean, I can beat myself up over how many times I screwed up with options. But that being said, I got a lot of 2Xs, I got a lot of 3Xs, and I've set my stops relatively nicely. So I'm way up with my options game. I made some painful lessons, but the reason I wanted to make this video was not only for some of my friends. I do a newsletter for some of my friends and friends of friends. I think it's like 40, 50 people on my list right now. I do it occasionally. I used to do it daily, but I started to do this for you guys. So it cut into some of my time. So, oh, and I do a lot of my blogging now. But basically, what I did with why I wanted to do this was I wanted to say why you do the options, what exactly they are, how you do them, when you would actually buy options. I would not buy them at a high RSI. Buy them when prices are low. And then also how to get out of them. And then lastly, I want to talk about some of the mistakes I made with them. So this is a primer to options. Start slow. And you can see through this video how there is some massive profits you can make using leverage. That being said, is the market's in a crazy place right now. And in any day, you can have So again, manage your risk, guys. Be very careful with this. I just wanted to tell you some lessons I had. Don't do what I do, especially when I bought at those fib levels. Don't do that. I'm not advising you. Listen to those guys that are smarter than me. I just wanted to show you an example of how buying at a certain level and selling at a certain level can get you much greater profits than just buying the shares outright. So with that, guys, leave any questions, comments in below. Any you pros out there that actually listen to this and want to light me up, go ahead. I don't really care. I'm an amateur. I don't pretend to be anything more than that. This was meant for the absolute newbie to stick his toes in the water. There are also some crazy strategies out there with options I didn't get into here. There's strangle options. I think something's called the Iron Condor. I don't know. There's crazy things out there. And a lot of these strategies are meant to hedge against, maybe you have a whole bunch of shares and maybe you want to hedge against things with puts. Maybe you have a whole bunch of profits locked in with your options, and instead of selling them, maybe you put in a put for a short period of time to preserve. There's a lot of different reasons for doing that, guys. I don't want to get into that. And yeah, with that, hopefully it spurred some questions from you. And any questions I get, because I do get a lot of emails from you guys to my Gmail account. I'll put that linked in there as well. When I get a lot of questions, I do have some people I can bounce some things off of. And I also do write a lot of blog stuff to follow up on some of these things. So pay attention to the blogs that come out after this. I think with my partner Ashley, I wanted to have a follow-up with this next week for a Q&A. So, you know, we can kind of touch on things. And if I don't know things, I'm not gonna pretend I do. I'll just say I don't know. Or any questions that come up from this that are really interesting, maybe we can have a follow-up and get somebody on here that I can give those questions to, and they can kind of frame this for you guys and get you better answers to. I know Chris Marcus at Arcadia Economics is a former options trader, and he does these 3-hour videos of option strategies. And yeah, I'm not getting I'm not getting into any of that, but take a look at his channel for more on options. For technical trading, I listened to a guy named John Howell that taught me some of the basics. There's a lot of guys out there that'll do that. So with that, guys, take it easy. I'll probably talk to you sometime next week. Thanks.
And as always, guys, please don't forget to like and subscribe to our channels. It helps the algorithm in YouTube send this video out more and more. We really appreciate all your support. Till next time.